What is up, guys, and welcome to Lecture 3 of the TCT mentorship, where I'm going to be teaching you everything you need to know about supply and demand. Okay? A lot of people have been asking me about how I put my supply zones, how I put my demand zones. Well, here it is. Okay? So, what is supply? A supply area in the chart represents an area in the chart where there were significantly more sellers than buyers, causing price to have an expansion towards the downside. And when price comes back to this area, we can expect those same sellers to protect their positions and therefore causing a reaction in price. Okay, so sellers stepped in at a certain price point, pushed price lower significantly, and the only people that can move the markets are market makers. Therefore, if we come back to that area, they'll most likely protect their positions by pushing price lower again when we come into it, therefore causing a reaction. And for demand, it works the exact same way. A demand area in the chart represents an area in the chart where there were significantly more buyers than sellers, causing price to have an expansion towards the upside. And when price comes back to this area, we can expect those buyers to protect their positions, therefore causing a reaction in price. Because guys, the only people that can move the markets are the market makers, okay? That's why smart money concepts also always made sense to me, because price is only moving in your desired direction if the market maker decides to move price there. So if we can allocate and we can see where they did what they did, we can trade with them. Therefore, supply and demand is also crucial. Okay, it gives us those POIs, point of interest, where we can potentially get a trade. Okay, so we have two different types of supply and demand zones. Okay, we have two different types of supply and demand zones. What do we have? Let's put this on log. I don't know why it puts it on log every single time. There we go. Okay. So we have order blocks and we have structure supply and demand. Let's focus on order blocks first. An order block is a demand or a supply area represented in a single candle. When we have a bullish order block representing demand, it's going to be the last downwards candle before the expansion away. And when we have a supply or a bearish order block, it's going to be the last bullish candle before having the expansion away. Okay. So in order to have a valid order block, you need a bearish candle followed by a bullish candle away that left a fair value gap. What is a fair value gap? It's basically when your wick high of the bearish candle and the wick low of the third candle do not touch, and you just purely have a body candle between these candle 1 and candle 3, leaving an inefficiency, a fair value gap. Okay, that's basically what a fair value gap is. It's when your first candle's high and your third candle's low are not connecting. You can see that represented in the gray area with fair value gap. That's why I call it a OBIF, order block with an inefficiency. That's what it stands for. Okay, so a bullish order block is simply the last bearish candle before having an expansion away that left a fair value gap. You need the fair value gap. If there's no fair value gap, it's no valid order block. And it's the exact same way the other way around. So when we're trending down, or a bearish order block, because it can also be created when we're trending up, but a bearish order block is simply the last bullish candle before having a bearish expansion towards the downside, where here as well we need a fair value gap. So it's a 3 candle formation. The last bullish candle and then 2 downwards candles having that fair value gap. And then the order block itself is just the last candle's highs and lows, including the wicks, okay? Including the wicks. So also right here, what you see that last bearish candle, and then you see the bullish candle, but the wick of the bullish candle goes lower. We always grab the wick low, and we always grab the wick high. Doesn't matter if it's candle 1 or candle 2 that has the wick high or low. But it's very, very, very simple. An order block is just a demand or supply area represented in a single candle. So for a bullish order block, the last bearish candle with an expansion away that left a fair value gap. And for a bearish order block, it's the last bullish candle before the expansion towards the downside, leaving a fair value gap. But you need that fair value gap. And why it works so good, including that fair value gap, is because the market likes to fill inefficiencies. And once it has done that, it oftentimes has a reaction. Okay, it reacts away after filling the inefficiency. So if you combine a generalized supply area where seller stepped in with the confluence of that fair value gap, it's like it filled the inefficiency and it mitigated supply in one. And they tend to work extremely well. I only draw my order blocks using this rule. You can go back in older videos, and we're going to go into the charts later on, but I only draw my order blocks using the fair value gap. That's why I call it OBIF, okay? Order block inefficiency. Now, we also have structure supply and demand, SS and SD. And that's also very simple. It's a demand or a supply area represented in multiple candles. I hate that they wrote A. In multiple candles, okay? It's that simple. So what you can see right here is that price is trending up, okay? We have a high, we have a low, we have a higher high. Right here, we can see that these last two downwards candles, okay, are grabbed from high all the way towards that expansion candle low and then dragged forward, also including the fair value gap. Also for structure supply and demand, we use the fair value gap rule, okay? I'm always using that rule when I'm drawing structure, but you can just see I'm using two downwards candles. I could be using the order block, but if the inefficiency is also from this candle, this entire area is range demand, because this entire area is where the sell to buy happened, causing the expansion towards the upside, meaning they stepped in this area on the chart. Now, the reason why it's called structure supply or structure demand is because oftentimes we just follow our structure. So if our structure is making lower highs and lower lows following the 6 candle rule, and we can use the entire move up, okay, we can use the entire move up before having the expansion towards the downside as our structure supply, as long as it has left a fair value gap. That fair value gap is always included. That inefficiency is always included. So it always needs to have that low not connecting with that candle from the expansion away, okay? You need that gap. You need that candle body, just the candle body, okay? And that's why it's called structure supply, because we can just use it drawing our structure, right? Where if we come back into this area, we can expect a lower high for a lower low. And with this drawing, I'm already referring a bit to refined zones, okay? Already referring a bit to refined zones, because refined zones are used understanding our overlapping market structure, okay? So I have taught you guys about the overlapping market structure, and that if we, for example, are trending down on the 4-hour, we could have our red structure pointing up. That's the only way to get from point A to point B, right? And that could be like the 30-minute structure. Well, now that you know that we have structure supply and order blocks, let's say that the inefficiency is applied in both scenarios, okay? So this whole range supply has an inefficiency below, so it is valid. We can have a more refined area using structure supply when drawing our structure on the lower time frames. Okay, so following our black market structure drawing that has a low, lower high, and a lower low, this entire thing is range supply because we have an inefficiency while leaving the supply zone, okay? And if we follow our red structure, we could have a high, higher low, higher high, and then a break. And then this entire pull up before moving down can also be your structure supply. But it will just be a more refined area, okay? Just more refined. But we can watch both. You can put them both on the chart because we're not trading the reaction of the order block. We're watching for confirmations in the order block, which will be TCT schematics. Now, and the exact same way or the exact same thing applies for demand, right? We can have an uptrend where this entire structure break with the high and the low right here, this entire thing is demand as long as it left the inefficiency above. But we can have downward structure to get from point A to point B that could break back to bullish right here, leaving an inefficiency, and that could be our refined area, and we can just put them both on the chart. Okay, so we have order blocks, right, which is just one candle followed by an expansion away, leaving a fair value gap. Or we have structure supply, which are multiple candles, and it can be multiple candles. Yeah, it can be multiple candles or just the entire structure pool, right? As long as it left that fair value gap, as you can see right here, from this candle low and then that candle high, they're not connecting, making it a fair value gap. Very important. Now, there's one exception. There is one exception of the inefficiency rule, okay? Don't know why this is all the way up here. Let's say we are in a range. Okay? It doesn't matter how this range was created. This is just what the range is looking like locally. Let's say we're in the range and our only supply zone, okay, is up here. We can see these last two bullish candles before having the expansion away, leaving that fair value gap right here, right? Leaving that fair value gap, making it a valid structure supply. Okay? If this got mitigated, remember, it's our only supply zone within the range, and it got mitigated ever so slightly, meaning price barely came into it, but it did touch it, and then we got the reaction away, and it's our only supply zone. What I'll do in that case is I'll just draw my structure supply up above that mitigation, and I'll still call that unmitigated supply. But I'll only use this if there's no other supply to look for close by, okay? And it was a tiny mitigation, meaning we just tapped into it. Like we barely tapped into it, but we technically did. So only when you have supply, and the same goes for demand, right? When it's the only supply and the demand area nearby, and it had a tiny, tiny, tiny mitigation, I'll just draw it above or below that mitigation. Above for supply, below for demand. Okay, that's the only exception of the fair value gap rule, of the inefficiency rule. So, it's important that you guys do not start to just randomly pull out order blocks on random points in the charts, because context is always key. And we've already learned how to build context using structure. Look where those higher lows are. Look where the markets are flowing and heading to. Look where there are ranges. Okay? Those have priority. We look where we are on the chart. We create our range. We pull our range. Okay? We look where the lower high for the lower low could be, or the higher low for the higher high. And then we start building more context by adding supply zones. You know, maybe we could put the lower high in right there that we were already expecting by looking at our market structure in the correct way. Or maybe we could have a range deviation in this demand zone because we have a correct range and we can expect higher prices from here by drawing our market structure and our ranges correctly. So we already have the good bias. Now we're just looking for those areas where price could move. But don't just start randomly pulling out order blocks, okay? So we mainly have three locations, okay? We have three locations where one is very simple. I call it our pivot point order blocks, okay? Pivot point OBIF, meaning we have lower highs and lower lows, And in that pivot point of the lower high, that's where we create our structure, or that's where we create our order block. Okay, very simple. It's just we're already trending down. We're expecting a lower high for a lower low. And we right there in that pivot point, we created some sort of order block. Very nice, okay? Very good place to put an order block in that pivot point because it just aligns with the structure. Okay, it aligns with the structure. Now, the same goes for bullish order blocks, right? When we're trending up, the exact same thing applies. We also can have order block and demand or supply, or structure demand and structure demand within a range. Okay, we can also have it within a range. And for our ranges, okay, we preferably want to look for order blocks, bullish order blocks, or bullish structure demand, right, in the discount section of your range. So we know we have the upper section of the range and the lower section of the range. And we know the price can have multiple rotations from low to high, low to high, low to high, etc. So we want to be looking for demand areas in the lower section of the range to potentially take towards a rotation back up towards the high of the range. And there we want to look for supply areas to take back towards the low of the range. Okay. So we can have order blocks in the discount section or order blocks in the premium section within a range. We can have order blocks in pivot points following structure. Or once we're trading TCT schematics, which you guys will learn very soon, we can also watch for supply above our range high and demand below our range low for potential deviations. So if you have a range, you can always look for an order block or structure supply above your range high where price could deviate into, okay, or a order block below your range low or structure demand below your range low, which price could also deviate into before coming back inside. Okay, so these are the three main locations where you want to be looking for your supply and demand zones. Pivot points on the chart. Supply in the upper section of the range, demand in the lower section of the range. Supply above your range and demand below your range. Okay, those are the best places to look for S&D zones. Okay, because they will align with having proper context, and context is always key. Okay, context is always key. So let's apply it to the chart, right, to visualize it. Let's apply it to the chart to visualize it. So what we can see right here is I have a range on Solana. Okay, I have a range on Solana. We have our range high. We have our range low. Okay, range high, range low. I just told you we can look for demand below our range low and for supply above our range high. That's one. Well, there isn't that much right here. Okay, we can check. Oh, I take it back, guys. So I take it back. What we can do is we can put a horizontal line so we know where our range high is, and we go to the left. I'm on the daily time frame right now. Where can we see a bearish order block? Right here. Why? Right here, you see the last up candle before an expansion down, leaving a fair value gap. There we go. That's our daily supply zone. Very nice. Above our range high. Definitely something that we need to watch out for coming into that main range high. Okay, definitely something we need to watch out for. You see that? And you can leave the fair value gap off. I'm just showing you, right? But definitely an area to watch out for. You see that last up candle before leaving or before having the expansion down, leaving that inefficiency. Okay. Now let's look within the range. Okay, let's look within the range because there's not that much here because we have this massive wick mitigating anything here on the left. Now, I'm checking, do we have any significant areas of supply in our upper section or demand in our lower section? We know price was trending up. That's our high. That's our low. A move back up to here confirms our range. Let's check for potential areas where we could reject from. Or your time frames, guys. We don't have to use fixed time frames. We just scan through them. I'm on the daily time frame right now. What do we see? What do we see? Right here, we see a last up candle before an expansion towards the downside, leaving that fair value gap here. Right here, leaving that fair value gap, making this a daily order block with inefficiency. Look what happened when price tapped into it. Amazing reaction, okay? Amazing reaction. Because you can clearly see that price is rotating from high to low, from high to low. And now we're kind of hovering around the low, okay? Do we have demand in the lower section of the range where we could potentially have a bounce to take towards the range premium? I'm just scanning. I'm just flickering through my time frames, guys. I'm just flickering through my time frames. I'm on the daily, 18-hour maybe. Oh, I'm seeing something here. Very doji candle though, 12-hour. Oh, would you look at that? That looks way better on the 12. You see that? A bullish order block, a demand zone. Your last downwards candle before having an expansion towards the upside, leaving an inefficiency. It's always a 3-candle formation. Always a 3-candle formation, okay? We need one candle to confirm the bearish candle, one candle to confirm the expansion, the other candle to confirm the potential fair value gap. Always a 3-candle formation, okay? Look what happened when price tapped into it. We formed actually a Model 1 accumulation schematic, TCT Model 1, and we went higher. But that's for something for later, to understand how to trade it. Okay? But this already shows you that I have this range confirmed right here, and by understanding how to draw your supply properly and how to draw your demand properly, you could have catched the rotation in here, waiting for a confirmation, and the rotation in here, which were literally already the main moves of this entire macro range, just by understanding how to draw a proper order block or structure supply and structure demand. Okay, now let's zoom in a bit more. Because right here from that reaction, we were trending down very aggressively. We were trending down pretty aggressively. Okay, we had a low, lower high, lower low. Okay, now using structure supply, can we draw this as our supply zone? Boom. Let's get rid of this. It's always less good, okay, when you have this wick here, because then you don't have the fair value gap, okay? Because the fair value gap is already mitigated, but it is mitigated from the top down, okay? Oh. It is mitigated from the top down, which is less bad. So if there's nothing on the chart besides this supply zone, I would use it and I would drag it a bit down, okay? Because it's coming from top to bottom. But for now, we're not going to use it, okay? We're not going to use it, but we're just going to continue keeping our structure pool. So we had a lower high for a lower low right here, okay? Now let's continue drawing. Lower high for a lower low. But look at this. Look at this, guys. Look at this. Right in that pivot point right here, we see this last bullish candle, okay? We see this last bullish candle before having a aggressive expansion towards the downside, leaving a massive fair value gap, okay? So this is definitely a very good area to look for a lower high for a lower low, continuing the trend down, okay? Because we're trending down and you have an order block in that pivot point. Now, understanding structure supply, you can use this entire range, because also pulling it from this low to that high, we still have that fair value gap. We still have the fair value gap here. And this is a perfect example of a supply area and a more refined supply area. We have a supply area using structure supply, and we have a more refined area using an order block with inefficiency in that pivot point. We're trending down, so we're already expecting a lower high for a lower low, right? And that was the perfect place where price put in that lower high for the lower low, okay? But guess what, guys? Guess what? Coming into that pivot point, into that lower high for the lower low, we created again another order block with inefficiency. Why? Right here, we see this last upwards candle before the expansion down, leaving a fair value gap here. So it's a good order block. It doesn't matter that this wick is higher. It means it just grabbed extra liquidity, which is totally fine. It mitigated that supply zone. Okay, it doesn't matter if this wick is higher. We just pull it towards the wick high. Doesn't matter if it's candles 1 wick high or candles 2 wick high. And look what happened. From there, we got the retracement, did not yet come back to that low, and then got the move up. Okay, so now we can continue drawing our structure. There you go. But, continuing drawing our structure supply, we have yet again another supply zone. We have a lower high for a lower low that left here a fair value gap. See that inefficiency from that low to that candle? Fair value gap, making this valid supply. Look what happened when price later on came back into it, right? Look what happened when price later on came back into it. Not only that, we can make a more refined zone. We can make a more refined zone because right here, we can see those last upwards candles, right? We can see this last upwards move before coming down, also leaving an inefficiency here. From that perspective, making this a more refined area. But we can make it even a more refined area because in that pivot point, guys, in that pivot point, right, from this other structure pool, overlapping our structure now, we have an order block. The last upwards candle before having an aggressive expansion down, also leaving inefficiency. So this way, you have supply and supply and supply, and it doesn't really matter. You can just watch the entire biggest supply zone because we're waiting for confirmations either way. But it's funny to see that price really left no supply untapped because it came for the most refined area, right? It came for the most refined area, which was that order block. And it's actually funny because you can already see a bit of a supply chain here. And you may ask, well, is a supply chain? Is when an order block creates another order block that creates another order block. So you can see right here that this 2-hour order block created that 2-hour order block. Put it like this. This 2-hour order block created that 2-hour order block that created that 2-hour order block. So there's a little supply chain that's going on. Very nice to see. And a little tip and trick that I wasn't planning on telling, but it just came to mind now, is that whenever you have your first order block creating your second order block, okay, the reaction from that second order block always tends to be very good. Meaning this third tap, that's the reaction from the second one, that tends to be really good. Okay, tends to be really good when you have an order block that creates another order block. So the second order block's reaction is typically very strong when it looks this clean on a 2-hour and just 2 order blocks. Very nice. Okay, very, very, very nice. Now, from there, okay, let's zoom out again because we had a very aggressive move towards the downside and then we had a move back up again, okay? Now, I'm immediately checking, I'm zooming back out. Do I have demand in the lower section of this bigger range, okay? I'm just scanning through my time frames, guys. I'm just scanning through my time frames. 18-hour, nothing. 12-hour, nothing. 8-hour, nothing. 6-hour. Oh, look at the 6-hour, guys. When we swept that low, we can see this bearish candle that what followed was a bullish expansion towards the upside, an expansion towards the upside, leaving a fair value gap. Boom. Making this a valid 6-hour order block. Look what happened when price later on came back into it. We got that move up, right? We got that move up. Now let's check this entire move towards the upside more, okay? I can see on the 3-hour right here, that we have some sort of bullish order block. Again, last downwards candle before the expansion up, leaving a fair value gap right here, leaving that fair value gap. So this is a bullish order block. Did that do something? It caused a tiny reaction. But we still ended up going lower, okay? No TCT schematic confirmed here. Understanding the bigger context, we knew that this was more important when trading TCTs, which you guys will understand later on, okay? And then I'm just flickering through the time frames, right? I'm just scanning. Where do I see potential order block? Oh, look at that. Look at that. On the 2 hour, when I'm following my structure from the low up on the 2 hour, I have a low, I have a high, I have a higher low, and I have a higher high. In that pivot point again, guys, in that pivot point, you can see this bearish candle, and what followed was an expansion towards the upside, leaving a massive fair value gap. Okay? Order block with an inefficiency, making it a good order block. Look what happened. Price came deep into it, but we did get that bounce, okay? Therefore, another thing I want to tell you is that sometimes we wick the order block. Sometimes you wick the order block. Doesn't usually happen, but it is possible that sometimes we wick it. That's fine. It just means we took liquidity from that point. And liquidity is actually going to be the next lecture, okay? It's going to be the next lecture, so don't ask what's liquidity. It will be explained in lecture 4, okay? So we're kind of already getting a feeling of, hey, I'm just flickering through the time frames. I see structure supply, I see structure demand. Let's look more locally, okay? Let's look more locally. Right here we had a range, okay? Right here we had a range. Let's go a bit more back in time. There we go. We had this range, okay? We had a range low, and we had that deviation tapping into that 6-hour order block we were just talking about. Again, guys, when price is right here, okay, imagine price being right there. I'm checking, do I have supply zones in the upper section of the range, and do I have demand zones in the lower section of the range? That's always what I'm checking. Okay? Because preferably we want to look for a short confirmation in the upper section and a long confirmation in the lower section, right? So I'm just scanning. Let's see on what time frame the range is valid on. We have a 12-hour range. Let's just flicker through the time frames to see where we see a potential order block or structure supply or structure demand. Most of the time you'll see structure supply and demand on the lower time frames and not particularly the higher time frames when you're trading a range like this. But yeah, what do we see? I see some sort of an order block here, but let's see in the lower time frame if there's something better, because this doesn't look the best because you have this low, you have this high. It is valid, but let's see if we can get something more refined. Flicker, more and more. Oh, look at that. I'm pulling my structure from top to bottom within the range. I told you guys, always watch for just the most recent rotation within the range. Look in that pivot point. We found a 1-hour order block. This last bullish candle that closed very, very tiny before having an expansion towards the upside, leaving a massive fair value gap. Okay, so that's definitely an order block. Look what happened when price came back into it. Okay, we got a nice reaction and we got actually a range formation. Now, looking at the lower section, do we have some demand before price, if price rotates back down for a potential rotation back up? Again, let's start on the higher time frame. I'm just scanning. I'm flickering through the time frames. I see a 3-hour order block, but that's already mitigated, right? That's already mitigated on this candle right here, so that's useless. Going on the 2-hour, it's also a 2-hour order block, but that's already mitigated, as you can see right here. And after a mitigation, guys, after a mitigation and an expansion away from it, we don't use the block anymore. Very, very important to clarify. The moment we get, a mitigation of our order block with a move away, we do not use it anymore. Okay, we don't use it anymore. But we can look for more refined areas, like we just discussed, and those could be still unmitigated. So I'm going on a 1-hour. Oh, would you look at that? On the 1-hour, we actually have this little zone right here. And that wasn't mitigated on that pullback. So we still have some unmitigated demand right here. Let's flicker on more on the lower time frames. Oh, would you look at that, guys? We have a 45-minute order block hiding down there. Maybe even lower. 30. Look at that. I'm drawing my structure from the low up. High, higher low, higher high. Right in that pivot point, we have that 30-minute order block. So you can call this an order block with an inefficiency, and you can call the 2-candle pullback structure demand, following your structure, right? With a more refined approach. And look what price did. It ended up coming back for that lowest part, right? Really leaving no demand unmitigated right here. Boom. And look what happened once price came into it. We got a beautiful expansion towards the upside. But where did price reject? Let's see. Did we have a supply zone in that upper section? Oh, would you look at that? Look at that 1-hour bullish candle that caused an expansion towards the downside, leaving a fair value gap right here. Price came back into it. Boom. Rotation back down. Rotation back down. So see how I am looking at supply and order blocks in the upper section of the range, demand in the lower section of the range locally, and I'm doing the exact same looking on a more macro scale with supply in the upper section of the range and demand in the lower section of the range, while also when we're trending down, okay, and I'm trying to catch maybe a continuation trade using TCT concepts, I'm checking my structure and I'm looking for those pivot point supply zones, right? Either an order block or structure supply. It doesn't matter, okay? It doesn't matter. And I know we were trending down very aggressively here. So after a very aggressive expansion towards the upside, where could we potentially reject right here for a potential range? I told you guys, after a very aggressive expansion towards the upside, we tend to form some sort of a range, which you can see right here. Well, maybe that range high starts in that good-looking supply zone because it was the only supply zone in this entire move down because this was just liquidity, which is something we'll go into in lecture 4. Okay? So, in my opinion, it's not that difficult. You really just have to look and flicker through your time frames on what time frame you potentially have an order block. And it is always better to have an order block on a higher time frame that's also unmitigated on the lower time frames, okay? It's not a requirement. You can see right here that this was a daily order block, right? This was a daily order block with an inefficiency, but if I zoom in on the 3-hour, it was already mitigated, right? On the 3-hour, you already had that mitigation here, but you do not see that on the daily time frame. Now, if you have a higher time frame block that's also unmitigated on the lower time frame, that's even better, okay? But it's still valid to use that daily order block, and you can clearly see that it worked like magic, okay? This is one of the reasons why I called that short. You know, it's on my X profile. You can search it up. I called the short from here, literally. We shorted right there. Boom. Why? TCT Model 1 concept. 1, 2, 3. I can't wait to teach you guys it. I can't wait. Okay, we're almost there. We just need to lay this foundation. We have market structure. We have ranges. Now we also have the POIs, the supply and demand areas, either in the form of an order block or structure demand or structure supply. So tying it back, right? Tying it back to the last video where I was talking about why I was expecting a bounce and why was it so good looking. Well, if I put on the EQ of this range, you can see, oh, now that you know how to pull your demand zone, we can clearly see that right here, if I let's say go on the 4-hour, would you look at that? We had these downwards candles that caused an expansion towards the upside, leaving an inefficiency. Right here. From the high, you pull your range demand. From that first candle, boom. Very amazing inefficiency, right? And it was in the lower section of your range. Question for you guys, exam question. Is there another structure demand within the lower section of this range that we can draw? I want you to look closely. Look in this move up. Look in this move up. Is there structure demand that we can draw? Right here, guys. Right here. Okay? Right here, we can see structure demand. Why? We can see these two downwards candles, multiple downwards candles, leaving an expansion towards the upside, giving us an expansion towards the upside, leaving that fair value gap. Okay? For that fair value gap. Okay? But yeah, this was also a POI. So we had two areas of interest. If price came in here, maybe we could catch along for a rotation back up, right? And therefore, I was expecting a potential bounce or a range formation in that area. And let's look even closer in the range itself. Let's delete the EQ of the bigger range, otherwise it gets messy. Okay, we knew we had that TCT model 2 accumulation, which will all be explained later. But where did we bounce from? Did we reject from something special? I'm just flickering through the time frames. It's around the 4-hour range. I'm on the 2-hour now. Do we have something? No. On the 1 hour, do we have anything significant? Not really. 45. Oh, look at that, guys. Look at that. We had a 45-minute order block here. It almost got mitigated. It almost got mitigated here. If this wick was a bit higher, this was not a order block, okay? Because you didn't have an inefficiency. But right here, you still had that little inefficiency, and that's enough. You just need one. You don't need a big one. You just need an inefficiency, okay? And that's where we rejected. That's where we rejected, right? Absolutely beautiful. Do we have a local demand area? Oh, in this move up, right? I'm just following structure now. In this move up, we had a high, higher low, higher high. Around that lower area of the higher low, I see a 1-hour order block. Look at that. I see a 1-hour order block. Where you have this last downwards candle before the expansion away, leaving right here that tiny, tiny fair value gap. Very tiny, but it is one, guys. It is one. Very tiny, but it is one. So we rejected from the only supply in the upper section of the range because, scanning through my time frames, I don't see supply somewhere else but that area. And look at that. If I go on the 30-minute, we can actually see that there was a better supply zone on the 30, a more refined one, higher up, and price actually ended up coming for that. Was there maybe even a 15-minute one where price ended up wicking into? No, not really. So the moment our range is confirmed already right here, right? That's when our range is confirmed. Now, we have a move up, okay? We have a move up, and we know we can expect a reaction in here because it's the only supply remaining before coming to that range high, which are always the best ones. It's called extreme supply, okay? Extreme supply, aka your last supply remaining before coming to your range high, loves to give reactions. So that's also where we created that range. And it's beautiful because now you can expect some sort of potential range formation to be created after coming into that area, right? Now, where was our range low created? in that 1-hour order block. So you see how you can, with the amazing context, you can kind of already expect where that range is going to take place. And then from there, we had that wick. Obviously, we had that distribution. First, we had that accumulation, went over into distribution, went over into a bigger accumulation. But did we bounce from something here? Was there some demand in the lower section of the bigger range? I'm on the 2-hour, nothing special. Oh, would you look at the 3 guys? Last expansion down, sweeping your range low, bullish expansion away, leaving a fair value gap. And that's also going to be a requirement for trading TCT schematics. That, again, guys, I can't wait for us to reach that point in the mentorship, okay? I'm also making this in a structured fashion. But do you see how crucial it is that I was expecting this range formation to potentially create itself because we tapped into a high time frame area of structure demand, and then I expected this range to be created between that point and that point because those were our only supply and our only demand points. And then if you understand TCT schematics, you know that we can expect a bounce right here of this order block because that's extreme demand, okay? And extreme supply and extreme demand will also be more explained in the TCT concepts tutorial. Hope you guys understand order blocks more now. So we have an order block, we have structure supply. Let's recap it like we always do. We have supply and demand, an area that represents, or a supply area on the chart represents an area on the chart where there were significantly more sellers than buyers, causing price to have an expansion towards the downside. And when we come back to that, we can expect a reaction. Same for demand, an area on the chart representing an area where buyers were very more significantly active than sellers, causing expansion towards the upside. And when price comes back to this area, we can expect those buyers to step in, protecting their positions. We had a order block, which has to have an inefficiency. That's why it's called OBIF. And we have structure supply and structure demand, which are just multiple candles. And an order block is one. We have refined zones using overlapping structure. Okay, but we just have to watch where price comes, because we watch for confirmations either way. If that's in the bigger range or in the refined area, that doesn't matter. An exception is if there's only one supply zone remaining, okay, and we mitigated it ever so slightly, I'll still use it. I'll just draw it up, okay? I'll draw it above that mitigation. And then you want to look, like we just discussed in the examples, you want to look for order blocks in pivot points, or supply in the upper section of the range and demand in the lower section of the range, or supply above your range and demand below your range for deviations. So that's it for me, guys. Hope you guys understand order blocks now. Very simple, just one candle with an inefficiency, or structure supply, structure demand, multiple candles with an inefficiency, always using that inefficiency. And I'll see you guys in lecture 4, where we're going to be talking about liquidity. Peace out.